The following was recorded in front of a live studio audience at the Studio 21 Podcast Cafe. This is the United Podcast Network.
This is Africa Diaspora Connect.
Join us as we take the journey from the motherland to America.
We share our experiences and learn from them.
Here is our host, Kibathi Gaturu.
Welcome to African Diaspora Connects. I'm your host, Kibathi Gaturu, coming here from Studio 21, the podcast that brings to light our lives as Africans in the diaspora. My lens is in the U.S., but is applicable in any continent that we have decided to call home, away from that cradle of civilization we call Africa. Our goal is to bring to light that journey from the motherland and talk about our day-to-day ongoings in our assimilation to this Western Hemisphere. The topic today is Harambees, to do or don't. I mean, a term was coined by our founding father, Mzee Jomo Kenyatta. Let's all pull together. Where am I going with this? Now, it's imperative for us to pull together, all right? It's right there in our coat of arms. Our census statistics are staggering. I mean, 10 years ago, we had well over 3 million Africans living in the diaspora. 10 years ago. I mean, that figure today may have easily doubled. This is our home for a vast majority of us, whether we like it or not. We were not born here, but we will die here. Do I hear Harambe? Within my Kenyan community in Massachusetts, we easily lose a dozen or maybe more in a year from natural causes and others. Well over 90% of them do not have one valuable resource, that foundation that we came to build our financial homes upon, life insurance. Harambe! We're, in essence, building our financial homes on quicksand, a remedy for disaster, my brothers and sisters. It's not a matter of if, but when our financial homes will collapse. We're living widows and widowers with children in a very precarious financial situation. Our Harambe culture has a lot to do with it, and I'm sorry to be so explicit. We'll lay you to rest, no doubt. But then what? I mean, how's that mortgage going to get paid from a single mother's perspective? Are you ever going to afford college? How about those relatives that await that M-Pesa beep on their phone for mere existence? Life insurance ensures financial continuity to anyone and everyone that looked upon you for financial support. Our biggest plague is that financial literacy is never discussed at home, it's never taught in schools, and we learn by baptismal in fire. I'm a licensed life insurance agent. I've had the misfortune of losing 4 clients over the past 13 years or so. I've had the privilege, however, of offering financial continuity for the beneficiaries of my clients. All of them had kids, and actually one was a single mom. May they all rest in peace. Let me start off this very basic tutorial, okay? So I just told you what life insurance is. It ensures that financial continuity in the event of an untimely death. We all know that. Overheads are taken care of. Your shelter, your food, your clothing. For those you love, those you leave behind, your beneficiaries, everything is all set. What are the main mistakes that we make? One of them is the wrong kind. The biggest, I'll call it a bluff, a lie, is something called a cash value. And I know people are like, oh, come on, I have a cash value. What's wrong with that? A cash value insures you your insurance for the rest of your life, for 100 years, not 99 years, whatever they say. So basically they're telling you, you will never be without life insurance. But let me ask you a question. There's something called the theory of decreasing responsibilities. Over a segment of over time, the need for life insurance becomes less and less. Okay, let's think about it. You are newlywed, you're in your early 30s, you and your wife, and 3 years into it, you're going to have a few kids. When do you think life insurance is most prevalent? When you have a young family with kids, or when you're in your 60s and your kids are adults? Think about that. When your kids are young, or when they're older? You got it. When your kids are young, that's when you need life insurance. When you just bought that first home, that mortgage, that 30-year mortgage, you're living the American dream, you need life insurance. Because if anything happened to you, you're leaving your family in dire straits. As you get older and you do what's right and you pay off your mortgage, for example, if you can, kudos, your kids are independent, if they ever will be. They're in their 20s. Hopefully they got the best degrees out there and they're working. They don't really depend on dad and mom. All right? So if anything happened to you later on in life, the impact on your family will be that much less. So let me ask you a question. Why do you need life insurance for 100 years? A cash value is nonsense. You need life insurance for a term, T-E-R-M. Those critical formative years. Make sure that mortgage is paid off. Make sure your youngest child is old enough to depend for themselves. Get a term, a 20-year term, up to maybe a 35-year term. I offer up to 35-year terms. All you need is a term in which the significant factors really do matter. So if you hear a cash value, you run the other way. Cash values are darn expensive. They cost 6 to 12 times the value of a good term policy, okay? The cash values tell you also you're building a nest egg. You're building some equity, all right? But you know what they're doing? They're taking your hard-earned money, and they're investing it in the global economy, and they're giving you chump change. That's what they're doing. You can invest your own money by yourself with an experienced advisor. You don't need an insurance company to be investing your money. Think about it. And then they tell you can take a certain amount of your money and do whatever you want to do with it. It is your money. You have a cash value growing. You have a nest egg. What they don't tell you is this. If you don't pay back that cash value and you die, your family gets the premium less whatever amount of money you took out. You heard that right. Daylight robbery. Another thing, you have a $30,000 cash value. You've never taken out a dime. Okay? Guess what? You die. You have a $500,000 policy, and you still have $50,000 in the cash value. Your beneficiaries only see the half M. They never get to see the 50K. And yes, folks, it is legal. A cash value was designed for the ultra wealthy. It's for estate tax planning purposes. It lowers their taxable income. For us commoners, mwananchi, as we say in Swahili, we don't need to be messing with cash value. But the agent that sells the cash value make a killing on the commission by selling a cash value. It's all about the agent. So if you have an agent out there who's trying to push a cash value, tell him, hey, bloke, I was born tonight, but it wasn't last night. Term, do the right thing. Educate yourself. You heard it here at the African Diaspora Connect. We're moving on. The next issue is not enough. All right? I meet a lot of couples. They're like, you know what, Kibathi, I got life insurance. We're good. All right. How much you got? Let me ask. How much you got? 50,000. Interesting. You're insured. Kudos. All right. A typical burial will cost you what? 15,000? Something of that nature. So that's 50 minus 15. Bang, 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 bang. What? 35,000. Okay. You got your kids here. There's Juma here. There's Suleiman and Kamau and Aisha. You got 4 kids. You've been busy. You got $35,000. Your wife's got $35,000. What are they going to do with $35,000? You got life insurance. You got a term. But what's that going to do for you? You have to have the right amount. 8 to at least 10 times your income. At least 10 times your income. If you averaging $50,000 a year, I'm telling you, you need a $500,000 policy. If you're a Sonko and you're averaging 100,000, I'm talking about $1 million. Yes. You better have enough. It's all about continuity. Once again, it ensures financial continuity for those you leave behind. Now, what do you do with that money? You don't take that money and pay off your mortgage right then. No, I wouldn't advocate for that. Invest that money in the global economy. Your family's supposed to live off their interest. You have a $500,000 policy. You have a good advisor. Your rate of return is about 12%. A good advisor. It's not too shabby, and that's not impossible. It happens. The law of 72 says you take the interest rate, okay? Take 72 and divide by the interest rate equals 6. 72 divided by 12 is 6. So in essence, that money will double every 6 years, assuming you don't touch it. But you will. But guess what? Every year, at that 12%, your yield is about $5,000 a month. Every month, on a typical year, you're making 60 grand. So you can live off the 5,000 every single month and never tap into the principal. I hope I'm making sense. It sounds confusing, okay? But that's how it works. And then the other one that's also critical is the one that they give you at work. A lot of folks say, I got it, I'm easy, I'm cool. At work, yeah, you're relying on your employer to take care of your family when you pass on. You ever heard of a layoff? You ever heard of losing your job? Guess what happens to your benefits? They're gone. Listen, have a life insurance policy independent of your employer. Take the one your employer is giving you. Take it and run. Don't get me wrong. But that can be your sole thing. Okay? And then the other one that really is a big population is none whatsoever. Yes, you know yourselves, all of you procrastinators. Yes, every New Year's, this is the year we're getting life insurance. Yeah, we're going to get it. Yeah, right. It's like a gym membership. By February, all of you have quit. Yeah, I see you. Yeah, you don't have any. Come on, guys. The best consumer is an educated consumer. Okay? Cover your bases. That foundation is life insurance. Okay? What determines how much you're going to pay? What says, at the end of the day, how much is my premium going to be worth? What on a monthly basis? First thing is your age. Yeah, the older you are, the crazier it gets. All right? So secure a term policy while you're still young, vibrant, and healthy, and lock on it. It's never, ever going to go up. It's a term. It never increases. It's locked on. You're vibrant. You're healthy. All right? I'm not trying to discourage anyone who's older to get a policy, but the older you are, we start getting issues. Yeah, your back, yeah, your lungs, yeah, you can't walk, you can't breathe. Diabetes sets in. Yeah, you sneeze every day like a goat. We don't want your business. Ben, you're laughing. We don't want your business. That's my producer right here. He's a young dude. I gotta get your policy. We don't want. We don't want your business. So listen, lock on it when you're young. Your gender. So let me tell you something, guys. I got like 15 men up here. We are gonna go before our wives. All right. Statistics show we males we expire earlier than the females. I got an audience here. So guys, listen. Females, they outlive us. Why do we marry younger women? That's a topic for another day. We should marry older. I don't know. Anyhow, topic for another day. So, gender, women outlive us. Okay? So guys, our premium's always going to be higher. Your health. Like I said earlier, health is everything, man. You know, you're in good shape. Your BMI, you're watching your weight, guys. This is critical, man. You eat right, you exercise. You know, you actually get what we call, if you're really in good shape, you get a preferred policy. We even offer something called a preferred plus. Preferred plus, yeah, for them gym rat. You know, eating what do they eat? Salads and whatever boring stuff they eat. Yeah, not people nyamachoma at the farm in Chelmsford or whatever, Tewksbury, where you guys go. You know, forget that. Eat right, guys. Eat right. And then after health is a waiver of premium. A waiver of premium is insurance on your life insurance. So basically, if you get disabled, you can't work, and you still want to be covered, it will cost you a bit more on your life insurance just to have that waiver. So once you declare disabled, the company in of itself will take over the premiums, okay? So those are the main things that really determine how much. Your age, your gender, your health, and if you want a waiver. There's something called a rider, okay? It's an additional benefit, like that waiver of premium, that can be bought and added to the basic life insurance. So buying a rider means paying a little extra, okay? For example, there's an increasing benefit rider, an IBR. What that means is this. From an application perspective, the most you can qualify for is $500,000 with the application. You opt to take the IBR, increasing benefit rider, at 10% per year. So every year, your coverage goes up by 10%. So you start for $500,000. 12 months later, it's up to $550. So you were paying $70, $60, for example, for $500,000. All right? Your premium will go up by an extra a few dollars, maybe $5, $7, $8, whatever the case may be, but you don't have to go through underwriting. What is underwriting? To qualify, for you to qualify for life insurance, we have to check you out. We have to make sure you're healthy, all right? So we come to your home, We do vital signs, okay? We make sure that your heart is beating, that you do have a heart. We check your blood to make sure that you're disease-free. Because think about it, if you became terminally ill, everyone would be running to get life insurance. So we do a thorough check on you. It's a thorough physical. We draw blood. We check your urine, all that stuff. So we check you out. So in an event with an increasing benefit rider, you've gone up by 50,000, but we're not coming to check you out ever again. You'll never have to go through underwriting. So every year it goes up by 50,000 for a span of 10 years. So you start off with $500,000, and 10 years later you're at $1 million without having ever going through through the underwriting. Okay? And let me tell you something. With life insurance, whatever you're locked in, you're locked in. 3 years later, you start smoking like a chimney. You jump off from you're jumping from trains, whatever. You're covered. It's never gonna go up. It won't. It really won't. It's right there. We don't care. You gain 375 pounds. We are locked. We are liable as the company. Once we lock in, it's locked in. All right? A child rider. This is always a tough sell. A child rider, I'm basically saying this. In the event you lose your child and everyone cringes, oh my God, no, I don't want that. No. Guys, listen. Yeah, no parent ever wants to bury their child. But these things happen. For an extra $6, you can cover up to 10 children. I know some of you Africans are very active. You got 9 kids. All right? For an extra $6, we'll cover all your 9 kids. $6 up to age 25. All right? Food for thought. All right? And then those are the two main ones from that perspective. There's one little catch, however. There's one catch. Once you get your policy, you're automatically covered at inception. We have accepted a check from you. You're conditionally covered, all right? But I'll tell you this, though. There's a bit of a clause. It's not that easy. You can't commit suicide for 2 years. All right, let me say that again. No suicide attempts for 2 years. For 2 years, you can't do it. On year 3, we will get you. We will cover you. But the first 2 years, we do have a suicide clause, all right? Because we don't know what your state of mind is. We don't know why you want a policy. We can't really detect your state of mind. So the only thing out there that we ask you is first 2 years, suicide clause. If in the event you do commit suicide and it's deemed a suicide, your beneficiaries will get all the premiums that you've been paying for the past 18 months. If you're paying $100 a month, they'll get $1,200 plus $600. They'll get $1,800 that you paid in. But the $500,000 policy that you had will not come to fruition based on the suicide clause. All right? So you learned something. So what happens to your term after it lapses? Do you have a 20-year term? All right? You have 2 options. If it lapses, one option is, hey, it's been real. Shake my hand. See you later. Bye-bye. That's it. It's 20 years. You're still alive. And it's been real. Your other option is this. You can continue coverage. But now, you got the policy at age 30. Now you're 60. The rate will not be $100. The rate is going to be a lot of dollars. A lot of dollars. So you have an option. You can continue coverage for a lesser coverage. You had $500,000. You're like, Mr. Kibathi, I would like to continue coverage, but my budget, I'd like it to remain the same. We go in there, we do the math. We're like, okay, fine, Mr. Client, Mrs. Client, this is what we'll do for you. Based on your age right now, we can cover you for $125,000, and you can remain with the policy that you have for another 15 years. No underwriting. You don't have to have the nurse come and do anything. We will continue covering you even after it expires if you're willing to work with your budget and based on the reduction in whatever the case may be. But think about it. Your kids are grown. Your mortgage is pretty much paid off. Basically, all you're doing here is, hey, listen, if I exit, I just want to leave a little something, to my grandkid, the favorite one. Yeah, the one that looks like me, the one that's carrying my name ahead. Yeah, that one. That's basically it. But you don't have to do it. All right? So, how is life insurance paid out? Let me tell you something. After the death certificate is presented, Within 10 business days, I'll tell you this for a fact. Like I said, I've had the misfortune and the privilege as well of delivering a death claim. Within 10 business days, if it's 500,000 folks, there is no taxation on life insurance. It's 500,000 to your significant other. All right? We can never bring back who you've lost, but we will at least ensure financial continuity. All right? No taxation, or we can have it a direct deposit into your account directly. We could set a college fund for your kids as well. Whatever you want to do can be done. But folks, stay informed, okay, in this day and age. Stay informed, all right? The best consumer is an educated consumer, all right? Harambe is in our spirit. It's in our coat of arms. But folks, let's bury ourselves while we're still living. While we're still living, we will do the Harambe. We will still congregate. We'll miss you. But handle your business. Handle your business. These guys are laughing. Tough crowd here today, I tell you. Tell you that. Anyhow, if you have any questions for us, please send an email to African Diaspora Connects at gmail.com. Let me say that again. African Diaspora Connects at gmail.com. You can also find us on Facebook. The page is African Diaspora Connects. All right. You can find the show on YouTube, Podbean, Apple Podcasts, Google Podcasts, Spotify, and many other podcast outlets. Please remember to like the episode, subscribe to the channel, and hit that bell icon. Yeah, that one, notification, ding, when it's released. It's been a pleasure. Kibathi Gaturu saying sayonara. See you at an airwave near you. Africa Diaspora Connects. Let's give it up. Got it. There you go.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Cafe, the United Podcast Network, its partners, or affiliates.